Here's a sad fun fact. The first half of this year was the worst half for the stock market in the last 50 years, which is also why this clip is becoming one in every of my favorites. The stock market is about 20% higher. It has hit record after record after record on my watch. Stocks now down 7.6 trillion bucks for the reason that President Biden took office. Well, that's awkward now, as fun as politics is. This story is way bigger than politics. Check this out. In the month of September alone, the stock market misplaced more or less 9%, which is crazy when you remember the fact that the stock marketplace is supposed to make us about 9% per year on average. And we just lost a whole year's worth of gains in about 1 month. But believe it or not, that is not always the craziest story. The important story is that investors right now are terrified of the banks. Let me show you what I suggest. The Federal Reserve has begun to raise interest rates, or what's called the federal budget rate, and the worry is that they're about to break something. That something is Deutsche Bank and Credit Suisse. There are now rumors and whispers that these two major banks are on the verge of collapse, and their stock prices are starting to reflect that they are in danger now. The reason this is such a big deal, not just for the US, but globally speaking, is because both of these banks are assigned a role of what's called systematically important financial institutions, which is a fancy way of saying that these banks are too big to fail, which is why people are making the comparison between these two institutions and what happened to Bear Stearns and the Lehman Brothers in 2008. People are speculating that right now, this is more or less what's happening behind the scenes. Once again, even the CEO of Credit Suisse just recently said they were at a, quote, critical moment. They're planning to restructure, which is a little weird because if you asked your friend how their life was going, and if they said it's at an important moment and they were planning to restructure, he'd probably be a little concerned for them. But if a major bank told you that, that's when people really start to panic. Now, history doesn't always repeat itself, but sometimes it can rhyme, which is why this very famous quote by Warren Buffett kinda describes what might be going on right now. Only when the tide goes out to discover who's been swimming naked. And what that means is that only when the tide of money disappears do we get to see who the people were that gambled with money they didn't have and took on way too much debt and way too much leverage. And if you combine all of this with news of the fact that the Bank of England just recently bailed out the UK economy from a collapse, that the Russian economy is going through its own political turmoil, and that the Chinese real estate market is going through another potential collapse, we get a very dangerous recipe for another potential global recession. Now, I want to be clear. This isn't my prediction of what is going to happen, so I'm not trying to sound the alarm. Rather, I'm trying to explanation for the complexity of everything that's going on and why the markets are scared, so that hopefully we can better understand why this is taking and how it would affect us if it were to happen. So with that said, let's get right into it. Hi, my name is Andre Nick. Hope you're doing well. Come for the finance and stay for another banking crisis. So first, I'll give you the backdrop behind what's happening right now, and then I'll segue to Deutsche Bank and Credit Suisse. But first, the stock market is down 3 quarters in a row this year. The last time that happened was during the 2008 financial crisis, and that meaning is shadowing. No, luckily, the inventory market does not actually predict a recession. However, here's what kind of does. The Bureau of Monetary Analysis, which just recently put out their last estimate for the second quarter GDP. Remember, the GDP is what measures the health and growth of the economic, and that number gets released every 3 months. And if there are 2 negative GDP numbers back to back, regardless of what they are, as long as they're negative, that's when we get the official recession. Now, so far, this is nothing new because we already know that we're in what's called a technical recession, because the first quarter was negative 1.6 and the second quarter was negative 0.6%. Now there's a catch though, because every time the B releases their GDP numbers, as they gather more data, they like to revise those numbers 3 times. Sometimes those numbers go up, and then we find out we weren't in a recession after all. So just recently, the B released their third and final estimate for the second quarter GDP, and that number was negative 0.6%. Nothing's changed, which confirms we're still very much in what's called a technical recession. Obviously, people blame inflation for this, which is why the Federal Reserve has had to raise rates. But this is where it receives interesting, because every time The Federal Reserve increases the federal funds rate, we could also get ourselves into a situation where banks could get into main trouble. And here's how: whenever an agency makes some profits, it will invest some of that money in the bond marketplace. Because remember, bonds are a guaranteed way to make a safe return on your money, and in today's market, that's everything. So companies will use their balance sheet aka their portfolio, which includes these bonds, as collateral to take down a loan, same way that you might take out a loan using your house as collateral via the home equity loan, right? So with this money, companies will then take a risk with they'll invest it. This cycle repeats itself over and over again, but the problem is that right now, because the Federal Reserve is increasing what's called the federal funds rate, the value of their collateral aka their bond prices is cratering, and it's going down. Through extension, so are their stock prices, and that would potentially leave them, not in all cases, however, in some cases, exposed to margin risk or to have their safety scores downgraded, which could leave them asking the government for a bailout. And if that doesn't happen, that could lead to a collapse. That's terrible. Not only for that company, but for everyone else whom they've given money to, which in a bank's case is pretty much everyone. So that's the backdrop of the problem. Now, let me give you the specifics about these two banks. So here's just how big Deutsche Bank and Credit Suisse are to this story. Credit Suisse is a global investment bank that was founded in Switzerland. They are considered to be one of the top financial services companies in the world. In fact, you can consider them kind of like the Swiss Army knife, pun intended, of the finance world. Now they are one of the top 10 banks that are considered to be too big to fail. Their asset base, as it relates to what's known as the price-to-book ratio, is about the same size as the Lehman Brothers had in 2008 before their collapse. That is how big they are now. Credit Suisse also has a very, let's just say, interesting history. They were sued by the US in 2012 for selling residential loan-backed securities that were riskier than Credit Suisse was rating them to be. Throughout the years, they've been involved in dozens and dozens of lawsuits, scandals, and violations, including manipulating the Forex market, tax fraud, the recent Archegos scandal, where they lost $5.5 billion, money laundering, and helping the Russian oligarchs hide their money. Basically standard stuff, the things that banks consider to be the cost of doing business. But these are also some of the reasons why Credit Suisse's stock is down over 60% year to date, and it's down over 81% on all time. It's also why buyers right now are comparing what's going on with Credit Suisse to what befell to the Lehman Brothers in 2008. Now, just a warning, some of these comparisons which I want to show you are just anecdotal proof at best, but they're still worth explaining because some of them are hilarious. Like the first one, that is that the chairman of the board of directors of Credit Suisse, his last name happens to be Lehman. You can't make this stuff up, it writes itself. Their CFO's last name is Ponzi. Okay, the CFO part was made up, not my joke, but Credit Suisse did recently put out a statement saying that they have, quote, a strong capital base and liquidity in the bank, which is interesting because you know who said almost the exact same thing back in 2008, the Lehman Brothers CFO. Back then in September 2008, they said, quote, our capital position at the moment is strong. Yet it wasn't, though. But arguably the biggest piece of evidence against Credit Suisse right now is the price of what are called credit default swaps, which have now reached a price level that was last seen around 2009. So here's what they are. It's a little complicated, but buying credit default swaps, or CDSs, is like the equivalent of taking out insurance against an investment. Now, if your investment turns out to be right, you'll make a little bit less money. But if that investment goes to zero and it collapses, you may make some of your money returned, and technically, that is because what you're doing is you are buying treasuries aka government bonds from a third party. That's why there is counterparty risk. But the point is, the more risky an investment is seen, the more expensive that premium becomes. It is why we're seeing the price of the CDSs against Credit Suisse shooting up in price, because the market is protecting itself against their potential collapse. Now, this exact same thing is also happening to another most important bank called Deutsche Bank. They're massive, with an asset base that is larger than what the Lehman Brothers had in 2008, and they're also listed as a bank that is, quote, too big to fail. Now their stock price this year is already down 42%, and it's down over 83% on all time. So you can think of Deutsche Bank as sort of like the problem child of the finance world that simply would not appear to get along with anyone and doesn't want to play by the rules, which is also why they have a very rich history that spans decades of fraud, investor protection violations, interest rate benchmark manipulation, tax violations, banking violations. On it goes. So that is the story of these two banks, how big they're and why they're important. Now, let me just tie everything together. Credit Suisse manages $1.5 trillion worth of assets. Deutsche Bank manages $1.3 trillion together. Their assets under management, or AUM, totals roughly $2.8 trillion, which is roughly 4 times what the Lehman Brothers had under management at the peak. Before their collapse, also Deutsche Bank has kind of $47 trillion worth of derivative property, and if that bank goes under, so does the whole system, and the reason for that is because of what's called the contagion effect. It's exactly what it feels like. It's an effect that's contagious. When one institution fails, that leads to another, which results to another, which leads to the entire world. We already saw this happen in the crypto space earlier this year when Three Arrows Capital failed, which led to Terra Luna, which led to Celsius, which led to Voyager, and everyone else failing. It's like the domino effect. The difference, though, is that when the Lehman Brothers were selling these toxic insurances and CDSs that they could not pay their invest back on, is when they collapsed. All of the other institutions would have collapsed too if it wasn't for the government stepping in, bailing them out. That is additionally why you are seeing the charge of these types of insurances, specifically the 5-year CDSs, go up in value because as some distance as the wisdom of the market is concerned. The market is trying to protect itself against the possible collapse, and that's also why we're probably going to continue seeing a stronger dollar and more volatility in the stock market. This is and what the stock market is frightened of individually. I'm not going to do anything differently. I'm still going to dollar cost common into the stock market every single day, and that makes sense for me, but that's only me because I'm younger and I have the time for the market to recover. But I imagine if I was older and I was thinking about retirement, it would be a harder choice. That's why it is so important to start saving and start investing as early as possible so that you have the time to recover if anything like this were to happen when you're older. As always, I would love to know your thoughts about everything that's going on because it is still speculative. However, it's still really interesting. In the meantime, have a fantastic rest of your day. Smash the like button, subscribe. If you haven't already, don't forget to grab up to 250 worth of free Bitcoin with this link right here. Move it offline. Keep in mind to grab your free stocks. Links are down below. And then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video.